non-standard metrics, right? Then of course there is no definition for what they are reporting, and they can sort of make it look like however they want. In that case, you really have to look at what is the definition of what they are reporting. So that's what you have to look out for. However, when it comes to the calculation, now there is a lot of possible manipulation that can be done over here, and we're going to look at this in detail, right? I mean, of course, the very simple thing to do is, if you want to increase your current period income, you will recognize revenue prematurely, right? And if you want to increase later period income, well, you would try to defer that revenue to later periods. Very, very simple, straightforward. Similarly, if you want to increase your current period income, you could try to defer expenses to later periods, and if you want to do the vice versa, you could recognize future expenses in current period, so your future expenses will be less. What are the ways to do that? You already know the revenue recognition rules. Anyways, we're going to talk about that in this learning module a little bit more, and we will also be talking about what are the expenses in which management has some room to wiggle around and say, okay, can we bring this forward, or can we postpone this, right? So we will be looking at all those areas shortly, and it will be a little bit of a revision of all the other learning modules that we have already covered in FSA, because it will touch areas of both inventory and intangible assets like goodwill, etc. So we'll be getting into all of that shortly, right? You can obviously have your assets at a higher or lower value, your liabilities at a higher or lower value, because your different methods let you do that. So for example, different depreciation methods can help you change the value of property, plant and equipment. Different bad debt provisions can help you change the value of account receivable, or you can have your warranty expense helping you making that provision change, right? You can look into liabilities again with those assumptions. So all of these things are what we're going to look at shortly, that how the management can change these assets and liabilities values to impact your current earning income. Also, they could even classify non-recurring transactions as recurring transactions, and vice versa. Some recurring transactions they could classify as non-recurring. So again, that is a matter of, it's a subjective discussion that will this transaction happen again in future or not, right? So that is subject to management discretion. So we'll be looking at all of this, and of course the major focus is going to be on the calculation. But before we get into more detailed discussion about calculation, I just want to talk about the presentation a little bit more, that in what cases does this issue arise if they are using strange new metrics. So of course there is no standard definition for this. That's why it's very important that you look at what is the metric they are showing you, how do they define that metric, so that you understand exactly what they're trying to present to you, right? If they're giving you any projected statements, futuristic pro forma earnings, well, take that with a pinch of salt. And especially when it comes to EBITDA, I mean, your normal income statement is sales minus cost of goods sold is gross profit minus SG and A is your operating profit, right? This is what your standardized income statement is. Now, EBITDA comes somewhere between these two, because selling, general and administrative expenses include a lot of expenses which are non-cash. So to make your EBITDA look higher, they would try and deduct as less expenses they can from this. Of course, depreciation and amortization is something that is all right to not deduct from it, because this is earning before interest and tax and depreciation and amortization. So in terms of your EBITDA being more than your EBIT, okay, depreciation and amortization won't be subtracted from it. But sometimes what they do is they don't subtract a lot of other things, giving the justification that, oh, this is also a non-cash expense like depreciation and amortization. That is why we are not subtracting this, such as equity-based compensation. That, you've given stock options to your management, no cash has gone out yet unless they exercise, and at whichever point in future they will exercise those stock options, the cash impact will be at that point, since there's no cash impact now, let's treat these as DNA. Well, that's something you really need to be careful about, right? Similarly, maybe there's some rental payments going on, which is definitely operating expense, right? But they might classify it as an interest expense, and therefore it will be subtracted later on. And it will even make your EBIT look higher. Any acquisition related charges, they might not subtract from the calculation of EBIT, right? If your assets are going down, such as intangible assets like goodwill or other intangible assets, or maybe your PP&E is going down, maybe your inventory is going down, so they obviously can't hide the inventory impairment because that will be there in cost of goods sold. But PP&E and intangible assets and goodwill impairment, they might try to not deduct from your EBITDA. Litigation costs or other kinds of losses on your debt, they might try to also not deduct from EBITDA. And why do you think they're doing all of this? Because a lot of players in the market, they use EBITDA as a proxy for cash flow. Now that's not a very smart thing to do to start with, so it is kind of their fault, because EBITDA is a poor proxy of cash flow. But the reality is a lot of players do use EBITDA as a sort of a quick and dirty method to understand, okay, what's the company's income before any non-cash expenses are deducted, right? So that's why they would try to present this in a way which is overstated. Now coming to the calculation, and huge amounts of stuff is here that can be used to manipulate all of this. Now, first of all, playing around with revenue, right? So let's say FOB shipping point versus FOB destination. What does that mean? When you're shipping some goods, do you recognize the revenue when they reach the port where they're going, right? So when the customer gets it, or do you recognize the revenue when they leave your port from the shipping point? So again, if you want to prepone the revenue recognition, you can start recognizing when it's leaving your shipping port. If you want to postpone it, you can recognize when it's reaching the destination. You already know how inventory cost flow methods such as LIFO, FIFO, weighted average can impact your cost of goods sold and your profit and your ending inventory values. I'm not going to go into that because of course that has been discussed in detail in the respective learning module for that. But you do definitely, and you should by now, understand that how choices of inventory cost flow and inventory valuation impact your profitability and your balance sheet inventory values, and therefore these choices can impact your earnings, right? Similarly, when it comes to account receivable, what percentage of account receivable are you keeping as a provision for bad debt, right? When it comes to deferred taxes, there is something known as a valuation allowance, right? Which means, are you going to be able to actually have profits in future that will enable you to reverse that deferred tax asset? If not, then well, you need to book a valuation allowance. And of course, depreciation methods, straight line versus accelerated, and even not just the methods, also the estimate of useful life. This is up to the management what they want to keep, and it can really impact the amount of expense we book every year. So all of these we're going to now discuss, but before we do that, we're going to talk a little bit about the cash flow choices, and then we will get into all of these in a little bit more detail. Now, for the cash flow, you know, it is cash flow from operations, cash flow from investing, and cash flow from financing. There are a lot of things that we can consciously put in investing instead of, or in financing instead of operating, right? So if I want to overstate my cash flow from operating, any cash outflows, maybe I'm paying for rent of my machine or my facility, my office space, what I could do is I could say, hey, these are interest payments that I'm paying on my leases, and it's a finance lease, right? So I might try and put it over here instead of IFRS does allow you to do that, right? So this is a misclassification of cash flow, again trying to overstate our cash flow from operations. You could also not pay your accounts payable until the balance sheet date is over. So what you could do is kind of either delay the payable payment, right? So that it looks like you've generated a lot of cash this period, and then immediately in the beginning of the next period, you pay them. Or you could prepone it, and then if you want to sort of bring down your cash flow from operation, so you could manage that basically, depending on if you want to show it lesser this time and later the next time, just to show a smooth growth. So this is something that can be used. Interest capitalization. So this is something that we have discussed in respective learning modules earlier, that if you're paying interest on, let's say, the construction of a building, well, that can be treated as an investing cash outflow, because that will be capitalized. It will be treated as part of the investment into that building, right? So that cash outflow can be treated as an investing cash outflow instead of an operating cash outflow. And therefore, if it's going to be not treated as an operating cash outflow, then you will have a higher cash flow from operating activities. And we all know this, that IFRS allows you to put payment of interest in financing, right? Dividend payment, of course, is definitely going into financing. There's no option over there. And your receiving of dividend can be put in operating activities as well as investing activities. So let's say receiving of dividend and interest we are putting in operating, so operating goes high, whereas paying we are putting in financing, so operating is overstated that way. Now, how can you be aware of all of this and sort of detect all of this? The main thing, which I think cannot be overstated, is compare it to the industry, right? And most importantly, this ratio should ideally be 1:1. That is probably the best thing you can do, that you can look at the company's earnings and look at its cash flow, and ideally there should be a very, very strong correlation between the two. If there is a high cash flow or a low cash flow, then things are not normal, especially if the earning is very high. That means that there is a lot of accrual based earning being shown, right? And in reality, the cash is not coming in. So that could be a real warning sign. And of course, you have to compare it to your peers, to their peers in the industry. Now let's get into a little bit more detail. And all of this is related to previous learning modules because you've already studied all of this, right? I'm just going to help you sort of remember it and link with how that can change, how choices in these relevant areas can change your earnings and cash flow. So first of all, revenue recognition. I told you FOB shipping point and FOB destination. So if you are recording the revenue, recognizing the revenue upon shipment at the shipping point, well, that is earlier. Then recording it at the destination, that is later. So if you want to prepone, you can start recording at the shipping point. If you want to postpone, you can start recording it at the destination. But what we want to see is consistency in this, right? But if there is constant changes, if they are changing their revenue recognition policy, that means they are trying to manage their earnings. That is the red flag over here, that if you see there is no consistency in revenue recognition policies, there's nothing wrong with having a certain policy. Obviously, what we would want, what is more conservative, is to record later, right? But even if they are choosing to record upon shipment, yes, that is aggressive, but that would still be acceptable as long as they are consistent with it. But if they keep changing, that is a real red flag. Number one. Number two, what is channel stuffing? So let's say they give discounts to, let's say a management needs to overstate earnings this period. What they could do is they could tell their buyers, their customers, hey, we're giving you good discounts, right? Or you better buy extra from us now, not because we're giving you discounts, because we're going to raise the prices in the next year. So either way, either you threaten them with higher prices or you give them discounts and try to force them to buy extra from you in this year, right? So thereby having a higher revenue this year. Now, how can you identify that? Well, you can compare it to previous history, right? In terms of sales and also sales returns, that if there is too many high sales numbers over here, or the sales returns are higher than the past, or the amount of account receivable is going up in terms of days, in terms of receivable days, or what we call days sales outstanding, because that means they are just selling it to these guys on credit. They're not even paying them. They're just stuffing the channel. And it could very well be that they're selling it to them, they're billing it, they're not even shipping it, they are having it held back in their own warehouses. So if you see any of these things, it is a sign of aggressive revenue recognition and channel stuffing, right? And what else? You could get into details in terms of the breakup of the revenue arrangement. And the good thing about the accounting standard when it comes to revenue recognition is that they are required to provide us all these details, right? That if there is some rebates going on, any kind of details regarding the revenue recognition have to be provided in the notes, and you really need to go over those with a fine tooth comb when it comes to revenue recognition. The same thing goes for depreciation policies, right? What we want to see here is consistency. We want to see that the useful life estimates are in line with the industry, right? It's not like, so the Coke, let's say, is taking a 10 years useful life for a certain beverage machinery, whereas Pepsi is taking 15 years for it. Doesn't make sense, right? If it's a similar machine, why Pepsi is taking a higher useful life estimate, right? We don't want to see changes in the useful life estimate or the depreciation method. What we want to see is consistent approaches, and especially if there is any write down, we want to know why that has happened and what is going to happen in future. In terms of capitalization, again, this is you've studied this in detail. There are differences in IFRS and US GAAP. IFRS does allow development expenses to be capitalized, right? Research, obviously neither IFRS nor US GAAP allows it, but IFRS allows for development expenses to be capitalized, whereas your US GAAP only allows for software development expenses to be capitalized internally. However, if you're buying companies and business combinations, both of them will allow you to capitalize this. But the point is, how are you amortizing this if they have finite lives? What is the assumption of the finite life, etc.? All of that needs to be looked at in detail. In terms of your provision for bad debt, right? Doubtful debt, is that changing? Are they taking it as a percentage of sales? Are they taking it based on some historical analysis? Are they taking it, whatever their logic is, it has to be consistent. It has to be in line with the industry, right? And it has to be something which seems to be true compared to what has been their own history. So we need to see that they're not using this, and I have seen this practically happening, is that just to smooth their earnings, what they would do in bad years, right? In bad years, they would try to have less provision or maybe even reverse provision to improve the earnings. In good years, they would book extra provision, and then they would just smooth the earnings, and thereby making the earnings looking very, very nice, smoothly growing. The same thing can be done with your inventory cost. I don't need to explain to you how choices of LIFO, FIFO can impact your profitability and your balance sheet value of inventory, right? Again, what we want to see over here is that there is consistency. If there is any LIFO liquidation going on, then they have to tell you in the notes. It is a requirement by US GAAP, which is the only one which allows LIFO. So obviously this is not relevant for IFRS, but if they are doing LIFO liquidation, then they have to tell you, and you need to take that into account, because obviously LIFO liquidation will be increasing their profits, but it is not something sustainable, because they will not be able to do it once they run out of their LIFO reserve. With the tax asset valuation, again, you've got your valuation allowance that comes in over here, and obviously if your business is a going concern, you're able to have profits in the future, then you will be able to get these tax assets used. But if you are not, well, then you need to tell them that I'm not going to be able to get the benefit of these tax assets, and therefore you need to book that valuation allowance. They as in the company needs to book it, and you as an analyst need to make sure that they are showing you the relevant valuation allowance. Goodwill, of course, there is impairment of goodwill that is required to be done every year. The point is, are they doing it properly or not? Is the auditor properly reviewing? So for example, Facebook bought WhatsApp, right, for what, 9 billion, right? And So they're showing that on their books for 9 billion. Now, if whatever the logic was when they were buying WhatsApp, if that logic is still valid and they are obviously benefiting from that acquisition and benefiting in a way which is worth more than 9 billion, well, no problem. But if that's not true anymore, right, then that needs to be impaired. It needs to be brought down. So are they testing for impairment properly or not, or is the testing skewed? That is something you need to look into. Similarly, with your sales revenue, there is a certain amount we know is going to be coming back in terms of warranty claims, right? So what is the amount of percentage of revenue we are expecting to come back to warranty claims, because you have to provision for it, and this is a futuristic thing. Nobody knows how many of our revenue units, in terms of units what we've sold, are going to be claimed in warranty, right? So it's an estimate, and is that estimate correct or not? Has it been correct based on our past reality? So that is something you need to look into, because the management can play around with this. Needless to mention, of course, if there is significant, extensive dealings happening with companies that the management controls, and this is what happened with the Enron scandal, right? A lot of related party transactions were going on. They were able to have off-balance sheet financing through sister concerns or companies that they were controlling, and this is something that you have to be on the lookout for as well. So what are the warning signs? Well, you need to pay attention to revenue, any kind of aggressive revenue recognition, or any kind of changes in inventories, especially, when it comes to, you have to get into the breakup. So let's say if raw material inventory is piling up, well, that's not really a bad thing. Company is probably expecting future sales, and work in progress also not too bad. But if finished goods inventories are piling up, that probably means that, hey, they're not really being able to sell what they're producing, right? And of course, capitalization policy is changing. If they're starting to capitalize a lot of their expenses, they're trying to defer costs in terms of increasing useful life of assets, which means lesser depreciation today, right? All of that needs to be seen as a warning flag, red flag. And if the income is going up and cash flow is not keeping up with the income, that means a lot of income is being recognized based on accruals. Other warning signs already discussed: change in depreciation methods and useful life, any kind of fourth quarter surprises, related party transactions, we've discussed this. Playing around with non-operating or non-recurring expenses or sales, right? So either classifying non-recurring income as recurring income, trying to increase your income or increase your operating, right? So even non-operating coming into operating. So the objective being to try and increase your operating income as much as possible, or trying to push expenses down into non-recurring, non-operating. Again, the objective being to maximize your operating income, because that is what a lot of players, investors look at. So how can you keep an eye out for all of this? Make sure that the margins that this company is showing, especially the operating margin, gross margin, and of course, more importantly, the operating margin, should be in line with both gross margin and operating margin should be in line with the industry. If you're seeing that there are young companies who are just having, completely unblemished growth, then that is also a red flag. If management is providing very little disclosure, again, a red flag. And if they are too fixated on earnings report, that again is a red flag. So let's have a look at the summary. What did we talk about? First of all, we said reporting quality is not the same thing as earnings quality. They are two completely different things. However, when they both come together, you have the best part of the quality spectrum. Now, if your earnings are not sustainable, you come one step down. If your choices are biased, you come another step down. This is related to reporting quality, whereas this is related to earnings quality. Further, your reporting quality deteriorates if you start doing earning management, and then here, obviously, you're not even following the standards, and here it is complete outright fraud where you are having fictional transactions, fictitious transactions. So you have to understand the difference between aggressive accounting and conservative accounting. The standards are by nature conservative, right? But what we want to see is neutral. But if we have to choose one from aggressive or conservative. Definitely conservative is better. Right. Now, why do they do it? Their motivations, well, their compensation might be linked to earnings, right? They might want to boost the stock price, they want to hide their poor performance. And why would they want to boost the stock price? Again, their compensation might be linked to it, right? Or they might want to have any kind of prevention from debt covenants, that there is a requirement that, oh, your interest coverage ratio should be at least 5 times. So your operating income, or let's just say whatever is the measure that is being taken, your income should be X multiple of the interest payments. So all these motivations we have discussed, but they will only be able to do that if the opportunity is there, right? And opportunity is going to be there if the board of directors is ineffective, and therefore the internal controls are ineffective. And of course, rationalization is something we discussed, that how do they justify it to themselves, that why am I doing this, right? And then you've got your disciplining mechanisms, that number one, auditors, right? And who is enforcing this? The SEC. So in every country there are regulatory entities, right? And then you can have your providers of debt looking into this. So the bank will have contracts and with provisions to penalize misreporting. And of course, the stock market is going to start penalizing you by selling your shares if you are not doing very good reporting. Or similarly, they might start asking for a high return on investment if you want to raise capital from them, right? So if you want to minimize the cost of capital, if you want people to give you money and take less return from you, which is a lower cost for you, well, then you have to give them good quality reporting. Now, in terms of presentation, we already discussed this, that if they are using strange new metrics or they are talking about futuristic projections, you have to understand, okay, what is the definition, what is the assumptions that you are having over here, right? Because this is non-standard, so of course it's something that they are coming up with, so we really need to know what is the basis for them of coming up with this. Now, with respect to non-standard, one of the things which is non-standard is EBITDA. There could be a lot of expenses that they are also not subtracting from this and saying that, oh, because depreciation and amortization is non-cash, so equity base is also something we have not subtracted from it. Or they might say, oh, these rental payments are going to be subtracted as interest, that's why we have not subtracted from operating expenses, even though they might be operating in nature, right? Or any other charges such as acquisition or impairment related, or any other costs or losses, they might not be subtracting from EBITDA. So if you are using EBITDA as a proxy for cash flow or just to understand their earnings, well, you really need to look at what is used in their own version of EBITDA in the calculation. A lot of other non-standard measures might be used. So IFRS says if the management is using any non-standard non-IFRS measures, well, they need to give a definition and explanation, and you need to read that before you take those measures into account. And they must also explain why this measure is being used. Why is it a better choice with respect to, instead of just giving the standardized measures. Now coming to the calculation, here a lot of things can be done, right? When it comes to accounting methods and estimates, you've got your inventory cost flow such as FIFO, LIFO, you've got your valuation allowance for deferred tax asset, you've got your depreciation methods, your useful life assumptions, so that really impacts your depreciation. In terms of capitalization, again, finite useful life for intangible assets, so that again is an assumption. And goodwill impairment has to be done properly, so you need to check that as well. A lot of cash outflows can be put in financing and investing instead of cash outflow from operating, so that will reduce the reduction of cash outflow, that will reduce the outflow from operating activities, whereas a lot of the inflows can be put into CFOs and thereby trying to overstate your CFO. So that is something you have to be careful of. And of course, we already discussed the choices that affect financial reporting in terms of revenue recognition can be aggressive. You can play around with depreciation. You can play around with intangibles, account receivable provision for doubtful debts, inventory cost flow, LIFO, FIFO. We've already discussed. and your tax valuation, which is related to your valuation allowance, goodwill impairment, warranty, what percentage of revenue will be taken as a provision for warranty claims, and of course related party transactions. So we have discussed all of this in detail. We don't want any kind of biased revenue recognition or biased revenue expense recognition. So you need to be on the lookout for that. And of course, the timing with respect to these recognitions, either if you see that revenue is being preponed or postponed, or you see expenses are being preponed or postponed, if they want to smooth their earnings or they want to just, increase the current period earnings. So whatever the motivation for that, if you see any kind of inconsistency with respect to revenue or expenses, that of course is a warning sign. And not just timing, but also the location. That, if we are bringing up or taking down the non-recurring part, right, or the operating and non-operating part. So recurring and non-recurring, they could try and play around with that, and operating and non-operating expenses and revenue, they could try and play around with that as well. So the location is also important. So what are the warning signs you need to take care of? Look at the revenue recognition. Of course, all these details will be in the notes. You need to look at the inventory. Again, details will be in the notes. Same goes for your capitalization of your intangible assets, and the same goes for other things within the categorization of cash flow from operating, investing, and financing, as well as any kind of accrual based income recognition. And one thing, if I were to tell you one thing from all of this, it's very important that look at the relationship between net income and cash flow from operating activities. The higher the correlation in this, the better the earnings are. The lower the correlation, that means there is either too much accrual going on over here, which is not reflecting in the cash flow. Right, and then what are some other possible warning signs? Changing of useful life, changing of depreciation methods, fourth quarter surprises, too many related party transactions. You see moving up or moving down of non-operating or non-recurring expenses and income, right? So classification of some expenses as non-recurring to increase your operating income. Your operating or gross margins are not in line with the industry. You have an unblemished record of growth projections, minimalist approach to disclosure, and too much fixation by management on earnings reports.